Junk bonds, also known as high-yield bonds, are bonds that are rated below investment grade by credit rating agencies. These bonds are typically issued by companies that are considered to be higher risk, and as a result, they offer higher yields than investment-grade bonds. In this video, we'll take a closer look at what junk bonds are, how they work, and the risks and rewards associated with investing in them. What are junk bonds? Junk bonds are bonds that are rated below investment grade by credit rating agencies. Investment grade bonds are considered to be lower risk and have a higher credit rating, while junk bonds are considered to be higher risk and have a lower credit rating. Junk bonds are typically issued by companies that have a higher risk of defaulting on their debt obligations. These companies may have a higher level of debt, a weaker financial position, or operate in industries that are more susceptible to economic downturns. How do junk bonds work? Junk bonds work similarly to other types of bonds. When an investor purchases a junk bond, they are essentially lending money to the company that issued the bond. In exchange for this loan, the company pays the investor a fixed interest rate, known as the coupon rate, for a set period of time. At the end of the bond's term, the company repays the principal amount to the investor. Junk bonds offer higher yields than investment-grade bonds because they are considered to be higher risk. Investors demand a higher return to compensate for the increased risk of default. The main reward of investing in junk bonds is the higher yield that they offer compared to investment-grade bonds. This can be attractive to investors who are looking for higher returns on their investments. However, there are also significant risks associated with investing in junk bonds. Since these bonds are issued by companies that are considered to be higher risk, there is a greater chance that the company may default on its debt obligations. If the company does default, the investor may lose some or all of their investment. In addition, junk bonds are often more volatile than investment-grade bonds. This means that their prices can fluctuate more rapidly and unpredictably in response to changes in the market or the economy. Finally, junk bonds may be less liquid than investment-grade bonds. This means that it may be harder to buy or sell these bonds, particularly during times of market stress. Junk bonds can offer higher yields than investment-grade bonds, but they also come with greater risks. Investors who are considering investing in junk bonds should carefully evaluate the risks and rewards associated with these investments, and consider whether they are an appropriate addition to their portfolio. Junk bonds may be suitable for investors who are willing to accept higher levels of risk in exchange for higher potential returns. However, investors should also be prepared to tolerate greater volatility and the possibility of losing some or all of their investment.